What's up, everybody? We're back. We've got a special guest, one that shouldn't be so new to you. It's our dear friend, Randall Smith, a.k.a. Rockin' Randy, because he just did his first open mic night. Played guitar in Delray Beach. And what did you just say? You were literally dying of nerves? Is that what was going on?
Well, first of all, I'm a public speaker, so you would think that this would be easy for me. But going in a room with 120 people and pulling out my guitar and playing and singing was about the scariest thing I ever did. And I told my wife, but I didn't tell my kids or any of my friends because I didn't want anybody to go there because I thought I was going to chicken out and run out. And
Crying with your guitar.
So I'm like, I just got to do this on my own. And I sat there, and on a scale of 1 to 10, my nerves hit maybe a 4 a couple times, where I had the thought process, I could just leave. Why am I putting myself through this? Why am I doing this? But I stayed and I did it. And the audience was great. They always clap a lot for first timers, even if they screw up, which I did. But it was great. It was a lot of fun.
Is there a consistent open mic night at the Arts Garage here in Delray Beach?
Yeah.
Can I join you? I'll be your backup.
Yeah, you can.
Yeah.
The only thing you play is the skin flute.
You need talent.
Well, no, I play guitar. Randy and I have played guitar before. We had a little ranch video we did.
Yeah, we did. Except for I actually can play songs. Craig just knows like the intro to riff to 11.
Listen, I figured out very early in my guitar career that if you play like a good 4 riffs and stop, people just presume you know the rest of the song. So I know like 4 riffs of 100 songs. People think I'm like fucking Jimmy Page. Anyway, we're not here to talk about that. Rockin' Randy.
We're
Rockin' Randy, we're happy to have you, but your talents are not best used talking about guitar. Randy is my consigliere, which I got from The Godfather. I don't know what that means, but it sounds great. And all things financially, he's my financial guru. And for many people in the mastermind, he's been the same. And I appreciate Randy. I want to acknowledge you for taking all those calls. Randy's been very busy taking calls from people to help guide them in their financial questions and their own guidance. And, I always say I'm in the position that I'm at in large part because of my friends, and you're absolutely one of them. So Randy, I'm going to pimp you out once again. Randy at randysmith.net. Does that sound good?
I love that email address.
Randy at randysmith.net. And if you want to take an hour of his time, all he asks is for a contribution to warriorsailing.org. But we're not here about that. We're here because Peter and I are students of real estate. We love our real estate. And you being the most connected to the ground in the world of real estate, talk to us. What's going on? What's the mini snapshot? This is going to be a quick podcast, guys. So sit up, listen. We're going to hear from our resident expert, Rockin' Randy. What's going on? All things real estate, Randy.
So what I would tell you guys is, we've talked ad nauseum with your group about reasons to own real estate, right? Because it's one of the major asset classes. It's called an alternative investment, not only means alternative to stocks and bonds, but it really shouldn't be called that because brokers use alt as a dirty word. Real estate is held by the wealthiest family offices in America at about 33 to 50% of their balance sheet, okay? It's their rock, it's their anchor, it's their cash flow, it's their inflation hedge. So I think your listeners have moved past, should we invest in real estate, to, holy crap, I don't own any real estate. And I'm not talking about your house, people, because that's not an investment, because last time I checked, you write a check to your house every month. It doesn't write one to you, even though you can do well and pay off your mortgage and sell it maybe for a gain in the future. Investing in real estate is just an asset class, just like buying a stock or bond. And just like stocks and bonds, there's a time when the season is right to be a buyer, and there's times when the season is right to be a seller. And it's always good to be a holder, just like stocks and bonds, right? So think about that. I never encourage anybody to dump their stocks and buy real estate. Usually there's a tax consequence or whatever. I encourage people to decide the asset classes they're going to invest in and allocate a portion of their available investable cash every year into those asset classes. So if real estate is going to be a third of your portfolio, which it should be, and I'm past recommending it, it should be, okay? If it's going to be a third, then start putting a third of your money into real estate deals, right? And we've talked about the many different ways you can own real estate. You can buy stuff directly. You can invest in a fund. You could buy real estate through the stock market, which I don't recommend. But anyway, lots of ways to get into the real estate business as an asset class. But here's what's happening right now. Real estate had like a really good golden age from like 2019 to 2022. It was one of the most unique times because interest rates on fixed rate debt, 10-year debt, right? Now, when you buy real estate for commercial purposes like investing, you can't get a 30-year mortgage, right? You can get a 30-year amortization, which is the amount of money you pay down a principal every month spread out over 30 years, so your payments are lower. But the loans only last 7 to 10 years, then you have to refinance them, okay? And the United States is the only country in the world that I know of that does 30-year mortgages on residential houses. In Europe and Asia and other places, it's floating rate monthly for your house or 7 years, right? Somewhere in there. United States is unique in these 30-year mortgages. But when interest rates are low, you can buy more real estate, have low payments. You can rent it out to tenants. The tenant might be Walgreens or CVS, or for its residential, it's individual apartments. And the tenant pays you rent every month. You pay your expenses and pay the mortgage. And what gets left over is your profit that you put in your pocket. That's your cash on cash return. So when interest rates are low, you have more available cash when you buy interest rate. Now, the other side that happens when rates are low is the prices tend to escalate to offset some of the benefit of the low rate, okay? But generally, you will find more deals that work when interest rates are low than when they are high. So why is this? Because sellers don't want to accept that rates are high and therefore they have to lower their price. So over the last 3 years, as interest rates ticked up the fastest they've ever gone up, from essentially 0 to 5.5% in about 18 or 20 months. That was a massive jolt to the system. So what happened is sellers aren't willing to lower the price of the real estate because the buyers have a bigger cost to get into real estate. So they hold on and buyers don't buy, and there's no market clearing prices that make sense, and the market goes into what you call a freeze, right? I'm not willing to pay $1 million for that building, and you're not willing to take $850 for it today, right? So the market freezes. Then what happens is sellers get fatigued. They need to sell. They want to sell. They need to move on. They want to help their son or daughter build a business. Something changes in their life, and they want to sell this real estate. And now they're no longer hung up on, I really need $1 million for it or 10 million, whatever the property is. So they start to think in terms of what's the moving price that they can sell the real estate for. So right now, you're suddenly seeing transactions where people that were fixed at their price are willing to take 10, 15, 20% less than they thought they would get 2 years ago. So why is the season right now? Because interest rates have now ticked down already. Even though the rate hasn't come down, banks lower the rate in order to attract business because they know their borrowing cost is going to go down. How do we know the bank's borrowing cost is going to go down? Because we have this thing called the stock market, and there's a bet, and the bet is forward-looking interest rates. And the bet right now, because the Fed has signaled they're going to lower rates, the bet is rates are going down 1/4 to a 1/2 point in September, and then with further reductions. So what the banks do, because they can't sit around and not lend money because that's how they make their money. What they do is they say, hey, listen, I'm pretty comfortable. Rates are coming down. So we're going to lower our rate today, even though our cost of borrowing is higher. So they make less profit today, but they know they're going to be able to borrow money cheaper, 30, 60, 90 days from now. So we're in a window where the banks have lowered rates and the sellers have lowered price. Now think about what I did.
Randy, I just want to interrupt you for 1 second.
I know that was a lot.
That was a lot because I think you thought you were talking to Tiger 21 and you're talking to dentists, but it's okay. We're going to break this down. So one of the things I want to ask you is you always say to me, if you're getting a lot of deal flow over the last year and a half, it's been pretty stagnant because rates were high and cap rates were also high. So we saw a lot of
cap rates were too low. Actually,
cap rates were low.
Rates were high.
Right. So cap rate returns were low and borrowing was high. So we saw a lot of people borrowing at 6 to get a 5.5 cap. 5.5% return. And they said things to me like, oh, well, it's okay because it'll eventually grow into a good real estate investment. To which whenever I'd say things like that to you, you would literally look at me like you wanted to slap me across the face. You would say, that makes absolutely no sense. If it doesn't make money today, you can't buy an asset in the hopes that it's going to start to make money in the future. That's just poor business. So you said to me something recently, and I want to reiterate it for the public to hear it. You said if you're getting a lot of deal flow over the last year and a half, that means something's wrong. And can you unpack what that is and why?
Yeah. So where I just ended, and thank you for stopping me because I get so excited about talking about real estate. Where I ended was this weird thing where pricing's coming down and so are rates. That's magic. Cheap real estate with cheap borrowing cost is magic. That's the phase we're entering right now. It's just starting to happen. So what you just said is something that, if people have a lot of deal flow when it's not a good time to buy, it means they've lowered their underwriting standards. What does underwriting mean? Underwriting is what you do when you look at a piece of real estate and you want to buy it and hold it. You have to figure out if it makes sense. You do your due diligence or your underwriting. And when we need to do a deal, right? So who needs to do a deal? Let's say you're a real estate sponsor. That's called like a manager, right? A developer. And you have investors throwing money at you because they want to get into real estate because they listen to Randy and Craig and Peter on this awesome podcast. They decide to want to get into real estate. So they find real estate managers, they throw money at them, and the managers go, darn it, I have this money, I have to put it to work. So they go out and they buy deals when the time is wrong. And this is happening time and time again, right? It is not always a good time to buy real estate. There are times to buy, times to hold, times to sell, right?
Wasn't there a Kenny Rogers song like that?
Yes, it was, but that was
No
about
one to hold
poker,
them.
I believe.
No one to hold them.
Anyway, so over the last year, you've had a few people send me deals that I wouldn't touch because let's say it was an interest-only loan, let's say on a long-term hold. And
does he live in Texas, by the way?
And the cash flow looks good, but it's really smoke and mirrors. Or they're going to renovate
interest only, no principal reduction. Like imagine how sexy your returns are if you don't have to pay down principal.
Yeah. So just some of the fundamentals get skewed, and that's why it wasn't a good time to buy. I'm not saying there wasn't a good deal here and there, just by and large. The other thing that you pointed out was price, right? So one thing I want everybody to write down right now, get your pens out and write this down. Basis matters, okay? In real estate, you need to make your money on the buy. Don't ever buy something saying time will heal this. I'm going to overpay now, but in time it'll be okay. You can do that with your personal home because you get this way better benefit than investing. And that is you get the pride of ownership, having a house that's yours, being able to paint the walls and decorate and do the landscaping. I never care if somebody overpays for a house because they're probably going to stay there 5 years, 8 years, 10 years, and that'll all work out, whether you make money or not. But when you're buying an investment grade real estate, what you pay matters. That's your basis, what you pay for it. So a good sponsor will be looking at 20 and 30 deals a month and find 1 or 2 to enter due diligence and then 1 to close on every other or third month. So let me play that for you again. 1 out of every 60 to 90 deals. And this is when they get emailed a full package with a beautiful PowerPoint with all the pretty pictures of how much money you're going to make and how great the real estate is. A good sponsor, a good real estate manager is going to do 1 out of 90 deals. Okay.
Jeez.
Now, your listeners.
That's kissing a lot of frogs, Randy.
Your listeners are going to have a friend who did this deal over here and a cousin who did this deal and somebody else. They're going to see 3 deals and want to do all 3 of them because deals all look good on paper. We don't put bad deals on paper. We put things that look good on paper, but that doesn't mean they're good until you do your due diligence. So that's why I always recommend that when people decide to enter real estate, they either buy something close to them, something they know, like buying their own building if you're a dentist makes sense. Buying a building that's maybe a little bigger and you can sublet and become a little landlord, that makes sense. You can grow your practice into it. There's all kinds of reasons to buy your building. some dentists get into the real estate business because they buy the building across the street and they kind of build a little monopoly board of real estate in a market they're familiar with. Their friend is the realtor, or maybe their spouse, whatever. There's reasons to do that. But when your friends send me deals where they're going to invest 25K or 100K in apartments over here and apartments over there, and they don't know the sponsor and they've never done it before, it's cringeworthy, okay? Because there's a ton of people that will take your money, but you have to learn how to find the best in class deals and deal flow. And in the last 24 months, there just hasn't been much.
Right. So a little cursory walkaway example is if you have a friend who's giving you 10 opportunities over the last year, back to back to back, that would be a red flag for you.
It would be, unless they had some weird niche. They were
Right.
buying foreclosures.
And just so we're on the same page, I've brought you, Randy, alone, just things that I found on Zillow. And of everything I've ever given you, you've never said yes to me. You've never said that was a good one.
I feel bad, Craig, because we went through a period when what happened is Craig, I finally got him into real estate, and then he did his first couple deals and he got the benefits of depreciation. So he got these big artificial losses that reduced his income tax. Craig and I had one deal where the down payment, let's say, was 150 grand, and Craig saved 148 grand on his taxes.
Right.
And he's like, wait a minute, I didn't put 150 grand in that deal. I only put 2 grand in that deal, and I get $3,000 a month. And then once Craig, it was like a dog getting his first taste of blood. Then Craig wanted to do every deal. He was like a hammer, and every deal was a nail. Yeah. So Craig would text me all these deals, and he'd call for sale signs and talk to owners of buildings, and he'd send me every one. And one time I was driving up Federal Highway here in Delray Beach, and you sent me one, and you're like, this is the one. And it was the, whatever. And I literally looked at it, and I looked at the 3 bullet points, and I'm like, wouldn't touch it with a 10-foot pole. And I didn't text you back for 24 hours because I just felt bad. I didn't want to deflate you.
Yeah, you never liked one, which I like. I like that. I like that you have a very, so, that's why when you take me through these deals, I know that your barrier to entry is so steep and complex. I would not know. I'd look at an internal rate of return, an IRR that's 15-20%, and I would not know that was only interest only or whatever. So I had no idea. So you are my real estate consigliere, and I appreciate that. So what's going to happen now? So the Fed's going to most likely reduce 0.5%, or should I say 50 basis points? Does that sound better? Does that make you sound better when you say bips?
It sounds cooler, but I like to speak in percentages too.
Okay, so 0.5%. So that's going to free up capital that's been sitting on the sidelines. That means what? Prices go up in real estate, or?
Well, what happens is as rates trade down, values trade up. So there's these cycles, it's like an hourglass, there's times when it comes together and everything's just right. You can always find a deal, right? If rates are low, you can always find a deal. But when rates are low and prices are high, what kind of deals do we look for, Craig? When rates are low and prices are high, what we look for is value add deals.
Okay, got it. I knew that.
That somebody, hasn't taken care of. They can't get maximum rents. So we're going to take advantage of the cheap interest rate to buy a fixer-upper. We're going to do work and add value to the property and create a masterpiece.
Like what Michael does. If the property looks really good and it's got everything stable and he has no way to make it better, he's out. He's not interested.
Well, Craig,
that's a retail deal.
If a patient walks into your office and they've got the most beautiful pearly whites you've ever seen, they're not worth much to you because
they're just cleanings from here on in. They already had. I wish I would have known you did veneers. I just spent $75,000 on Dr. Schwartz right next door. But I'll come to you for my cleanings forever. So don't feel bad. I'll do that.
So fixer uppers, value add is one of the most. It's one of the best things in real estate because there's
value add's a complex word for a fixer upper, but it's the industry term. A value add. You add value. You know what you're doing. You want something that hasn't been painted in 10 years and the pool is closed down because it just needed a filter or whatever.
Now I will tell you that a lot of what I do is value add because I'm in the real estate business, but a lot of what I do when I'm just allocating capital, right? So if you just have 100 grand in the bank and you want to make an investment, You can buy a retail real estate investment, something that's already fixed, something that's beautiful, something that's got a tenant, something you can finance. And maybe you're only going to make 6 or 7% on your money in the first couple years. But over time, you're going to pay down debt, you're going to have the tax advantage, and the property is going to appreciate as the lease payments go up, because generally leases go up every year with payments. So it's okay to buy a retail deal that pencils out correctly. And over time, it just gets better and better. I promise you, if you buy Apple stock today, you're paying retail. You're paying what the market will bear. You're
right.
not.
So that's the market being efficient, meaning the price of the thing, since it's publicly traded, there's no delta, there's no alpha, there's no way to figure out what it's really worth.
And I will tell you,
or there is a way to find out. I just want to, can you explain that idea, if you don't mind, just so that people can understand that?
So there's a rate of return that people will accept to buy like triple net properties. These are properties where you don't have to do anything. Take a CVS. You can buy a CVS. It's a 10,000 foot building sitting on an acre. And as an investor, we can buy that building. But I want to make X amount on my money. Let's say I was writing a check for it, no debt. So that amount of money, let's say the market decides is 7%. So I want to make 7% on that CVS. Well, whatever the rent is divided by 0.07 gives you the purchase price. And if you write a check for 2.5 million and collect that rent, you're making 7% on your money. If you can borrow money to buy that, that's leverage. If you can borrow money less than 7%, now you're making the delta on the money you borrow. That's the arbitrage. One of the best things about real estate is we can borrow money to buy it. And the land and the tenant pays the mortgage off for us. Real estate is not about getting rich quick. It's about getting rich slow. And it's really the best way to get rich, because usually the get rich quick deals kind of run away just as quickly, go like this.
One more thing I want to just, comment on that you've taught me, and it just kind of struck me when you were saying that. You have a couple ways of explaining things. Number one is depreciation. So you say that appreciation means it goes up in value. Depreciation is the government allowing you to pretend that every year it's worth less money. So I love that little saying.
You just nailed it.
And then you say something else that's just a little tidbit here for people to chew on. When you tell me, whenever I would tell you, like, I made $100,000 on that house that I owned, you said, no, you didn't. Yes, you made $100,000, but you didn't make $100,000 on the $1 million house that you sold. You made $100,000 on the $300,000 of equity you had in that property. So your $300,000 made $100,000. You made far more. So we tend to look at the amount we made as a percentage of the sale price. You always have to think of return on equity and return on cash.
That's the only way to compare it to other assets.
Right. But no one does that.
And that's the benefit of real estate. With real estate, the bank's happy to lend us 65, 70, 75% of the purchase price. Trust me, you can't go to Merrill Lynch and borrow 75 cents on the dollar to buy Apple stock, because if a bomb goes off tomorrow in some city in America and Apple stock goes down 50%, you get wiped out. So they don't allow that, right? But in real estate, a bomb goes off and CVS still pays the rent every month. Think about what I just said. Think about what I just said. The structure doesn't fall down. The land doesn't go away. The building is still there. Whether we're in a war, whether the Twin Towers fall down, whether COVID happens, the tenant has to pay the rent. These are why these are such, like, most of the high net worth people that I know consider real estate, they call it their anchor. It's their rock, right? So anyway, to sum it up, you have the best tax advantages. You can use other people's money, like the bank, for leverage. You have somebody in the bill, paying you rent every month that gives you cash flow, right? And they pay down your mortgage for you over time, and you build wealth while paying little to no taxes doing it. There is no other investment I know like this, guys.
And on top of it all, the wealth that you build is locked away from your other hands that want to tell you that it's time to buy yourself a Porsche, because it's equity. So you would always tell me, when I say, how much money did I make? You would say, well, how much did you pay down in your principal on your building? You would always add that to the wealth that I made in a year.
It's putting money in your pocket and you just can't see it because you're paying.
It's so good. That's the best money to make. We
Yeah.
as dentists get completely hammered. The tax code is built on the backs of people like dentists. We're high W-2 earners. There are people that make 4 and 5 times or have 4 and 5 times the wealth that we do that pay a fraction of the taxes we do. Not because they're breaking the law. It's just that we are in a very inconvenient segment of the tax code. We get hammered. High W-2 earners.
Yeah. If you read the book, Rich Dad, Poor Dad, which I always recommend is my very first primer book for anybody. And if you say, oh yeah, I read that book, I say, how long ago? And people will say 8 years ago, 10 years ago, 20 years ago. I say, read it again today and then read it in January every year, right? Getting to the right side of the tax consequences of being a business owner versus W-2, and then learning how to invest with after-tax dollars with pre-tax dollars is just the most fundamental way to increase your net worth, up and to the right as fast as possible. The other thing, Craig, don't forget, is we have deals in the pipeline and we have deals coming now, which is why I called you the other day, which I think was the genesis of this pod. And so anybody in your network that wants to go to Bulletproof and sign up on the real estate tab will be invited to the webinars that we will host, where we will introduce deals that we have the pipeline. And we have a multifamily deal in the pipeline. We have another triple net deal coming up in the pipeline. And I know it's been maybe 6 months or whatever since we closed on the last deal. And that was an industrial deal in Minnesota. And that one's doing great. Everybody's getting their checks every month. And depreciation. And, so it's just working well. We have good partners and good sponsors. So there's more in the pipeline. So sign up and be invited and get to hear us talk about the next couple deals.
Can you talk about the from current event standpoint? So we're now in August 22nd, and there's some pretty big Fed meetings coming up with, like you said, the anticipation of a series of rate cuts. So you're like, we're in that Goldilocks phase where there's been a stagnation in sales in the market, right? So prices have been trying to come down to find the mix to sell, and now rates could be coming down. So there's a period, kind of a Goldilocks period, where you can find really good deals if you have dry powder to deploy for real estate. Is that what you're saying?
Yes. And Peter, that time can last a year, right?
Yes.
Because people forget the old prices. They accept the new prices, and they kind of forget, the great thing about real estate is it doesn't have a ticker tape, right? Like Craig and I always talk about what our houses are worth because that's fun. But if you drove home every day and there was a big machine on the wall in your garage that told you today's value of your home, if you actually wanted to sell it today, like this is what the offers would be, it would make you sick. Because, one day it might
sell it. Yeah. If there was a button to push to sell your real estate, you would overreact. That's why that's the only precarious part of the stock market. If you just stayed in the S&P for any 20-year period, you'd kick ass. The problem is Russia invades Ukraine, and you could just go to E-Trade and hit one button. Are you sure? You don't have to ask, are you sure? I have to hit 2 buttons to update my iPhone. I can just sell my shit on E-Trade. No problem. Boom.
When I did my deep dive on digital assets and Bitcoin, and I decided that I wanted to put a percentage of my net worth in it, I didn't do what everybody.
Did you say a percentage?
A percentage.
1%.
That's so weak. 1%.
No. I didn't do 1%. Come on, give me credit.
You did 2%.
So no, I did more than 2%. Anyway,
double digits, or we can't be friends.
No, it's not double digits yet. Not double digits yet. But anyway, I purposely put it in my PayPal account and I put it into a fund. I didn't want it to be somewhere where I could easily transact it.
Oh, there you go.
Because I didn't want my finger on the finger.
You could have done that with cold storage, but that's another topic.
I know. But I learned that later.
Where I want to just keep expanding on, Randy, is that's why I brought up the date of where we are, right? So in the next Fed meeting, if they drop 50 basis points or 0.5% interest, that's when you start getting movement in the market, right? There's deals that liquidity is coming to the market. So you don't want to be the person who decides a year from tomorrow, let's just say, when the market has adjusted, and be like, I think I want to get into real estate. That's what I'm saying. There might be a Goldilocks scenario with some deal flow. There may be some deal flow coming to us, and it may be a perfect time to kind of invest based on the yield of what
Absolutely.
you get. Yeah.
Absolutely.
So that's why I think it's a good time.
Rare. These times are rare, Peter,
Agreed.
and we're in one of them.
I agree.
Yeah, we are.
Right.
It's an exciting time.
Yeah.
Yeah.
So,
Yeah.
so just so everybody knows, that's going to bulletproofdentalpractice.com, and the upper right is the real estate section. Just sign up and you'll be invited to the webinars. My suggestion is sign up and go through the webinar if
Yeah,
this
just
deal
learn.
comes, just to learn.
Yeah.
Because if I would have
there's
just,
no obligation.
There's no obligation, yeah.
You'll learn a lot. And remember, looking at deals builds your acumen. You want to look at deals. You don't have to do them. You want to look at them and
It
see
builds your I mean, you're going to be looking at deals. If you're an entrepreneur or the breadwinner in your family, you are going to be looking at deals until the day you die, regardless of if they're dental deals, real estate deals, whatever. I mean,
Absolutely.
deals are universal. Meaning the muscle you're building, Randy, transcends all things.
Absolutely.
So
Absolutely. No
yeah,
bad.
it's applicable to all things too. What you learn from evaluating a real estate deal. I mean, it's compelling because at a certain point, I tell Peter this. It's like when you're starting out, you have to take 30 cents and turn it into $1.50. You need to swing for the fences. You need asymmetric upside. As you start to mature and your business is matured and you're actually operating an efficient dental business, you have superfluous cash. What you choose to do with that cash has to be more conservative and less risky. You want to take dollars and turn it into $1.15.
Make money in your business and protect your money in your investments.
Right.
Hey guys, I have to jump. I actually have a real estate call to get on right
Good
now.
stuff.
Thank you guys for your time.
Randy.
Thank you, Randy.
Finish without me. Can I trust you guys to run this pod without me?
Yes,
it's over.
Of course. You can
It's
hang up and you're in good hands. We won't steer
Bye,
it to the
everybody.
ground.
We will publish it. See you, bud.